financial statements are an output of financial accounting department. Accounting is an information system, as we discussed in management accounting, and financial accounting department produces reports which are the responsibility of the management or directors more precisely, but they also use those financial statements to assess how the business is performing. These reports are produced via process, and the process is that whenever a business carries out a transaction, but whenever a transaction happens, businesses are required by law to record those transactions. Before they could record it, accountants, financial accountants, they have to analyze that transaction to assess in which part of the accounting records it needs to be recorded. There are 5 major parts of financial accounting records. The first one is an asset. An asset is anything which a business owns. Simplification of the concept. Anything which a business owns or controls is called an asset. For example, a building or vehicles or furniture or fixture, land, plant and machinery, etc. The second part of the records is a liability. Anything which a business owes, for example, a bank loan, or when you took admission in the university, you deposited some fee for the cash letter. When university received that fee, it was recorded as a liability because we still haven't provided our service to you, so it will be recorded as a liability. Once we have done the teaching, completed the course, your fee become our income, which is a third part of the records or type of the accounts. You go to Sainsbury, you buy stuff from there, those sales are their income. So income, revenue, or sales are the same stuff. The fourth head of accounts is called expenses. Overhead, rent rates, we look loads of expenses in our management accounting study unit. So that's what there are. And the fifth part is owner's money, called equity or capital. Whenever somebody starts business, they invest their own money into the business, and it's called capital. So this is a very quick overview of 5 heads of accounts. So first they analyze the transaction and assess in which area of these 5 heads of accounts the transactions needed to be recorded. And throughout the year, even for a small business, maybe a grocery shop or a corner shop, there are hundreds and thousands of transactions for even a small business. For a business like this university, there would be millions of transactions in a year. So all those transactions are summarized at the end of the year and presented in the form of the financial statements. So the process starts from a transaction, ends at the financial statements. There are 5 parts of the financial statements which are produced. The first statement which is produced is called income statement. 2 of the head of accounts, income and expenses, are summarized and presented there. This statement tells us if the business has made a profit or a loss. The second statement is called a balance sheet or statement of financial position, where the other 3 heads of accounts are summarized and presented: assets, liabilities, and capital. So what is the state of assets, liabilities, and the capital? They're presented on the balance sheet. Now we have covered all the 5 heads of accounts. So what do the other 2 statements do? 3 parts do. The third statement is called a statement of cash flow. This tells us what happens to the business cash throughout the year. Cash is an important thing, so more explanation is needed. Why? Let's take a very simple example. Business A had £10,000 at the start of the year on 1st of January, let's say, and on 31st of December they had 100,000. 10,000, 100,000. Business B had 100,000 at the start of the year. on 31st of December they had 10,000. What would you think? Which business has performed better, A or B? A, yeah, because it has increased its cash. But this may not be the case. There are hundreds of reasons this may not be the case. So what we need to understand is what happened to the cash, what were the fluctuations, and if you read the whole article on statement of cash flow, you will enjoy that because it gives you some really good examples on why it is important to understand what happened to the cash in the business throughout the year. The fourth statement is called statement of changes in equity, which explains what happens to the owner's money throughout the year. Sometimes owners add more money into the business, sometimes they take away money from the business, and there are other things which we will explore later on in the next 2 weeks. So these are the four parts, four statements, and the fifth part of the financial statements is called notes to the accounts. These notes explain those four statements in more detail.